Let me tell you something that might change how you think about investing in retirement. If you are over 70 years old, the rules that applied when you were building wealth no longer apply. The strategies that worked in your 40s and 50s can actually destroy your financial security now. And the conventional advice you hear from most financial advisors, the standard recommendations about asset allocation and risk tolerance, much of it is dangerously wrong for someone in your situation. I have spent over 30 years managing money, studying markets, and analyzing what actually works versus what sounds good in theory. I have made billions of dollars for investors by understanding risks that others overlooked and opportunities that others dismissed. And I can tell you with complete conviction that most retirees over 70 are invested incorrectly. They are either taking far too much risk, chasing returns they do not need and cannot afford to lose, or they are being far too conservative, watching inflation slowly destroy their purchasing power while their money sits in accounts earning almost nothing. There is a better way. There are 4 specific investments that I consider the safest options for retirees today. These are not speculative bets. They are not complicated strategies that require constant monitoring. They are straightforward investments that can provide income, preserve capital, and let you sleep at night knowing your financial future is secure. But before I reveal these 4 investments, I need to tell you a story that will help you understand why safety in retirement is so different from safety at any other stage of life. It was 2008, and I was watching the financial system come apart at the seams. Lehman Brothers had just collapsed. Banks were failing. The stock market was in freefall, and I received a phone call that I will never forget. It was from a man named Richard, a 73-year-old retiree who had attended one of my investor presentations years earlier. Richard was calling because he did not know what to do. His portfolio had dropped 40% in a matter of weeks. He was watching decades of careful saving evaporate before his eyes. Richard told me his story. He had retired at 65 with about $1.2 million saved. His financial advisor had put him in a portfolio that was 60% stocks and 40% bonds. The advisor said this was appropriate for a retiree who needed growth to keep up with inflation. For 7 years, it worked fine. The portfolio grew. Richard felt comfortable. He was withdrawing about $50,000 per year to supplement his Social Security, and the portfolio was still growing despite the withdrawals. Then 2008 happened. His $1.2 million had grown to about $1.4 million by early 2008. By March of 2009, it was worth $780,000. Richard had lost over $600,000 in value, nearly half of everything he had, and he was still withdrawing $50,000 per year because he needed that money to live. He could not simply wait for the recovery. He had bills to pay. He had a life to fund. I asked Richard what his advisor was telling him. The advisor said to stay the course, that the market would recover, that selling now would lock in losses. And technically, the advisor was right. The market did eventually recover. But here is what the advisor completely missed. Richard was 73 years old. He did not have the time to wait for recovery. Every month he spent waiting was a month of withdrawals from a depleted portfolio. Every year the market stayed down was a year that his remaining capital had to work harder to sustain him. By the time the market recovered in 2012, Richard's portfolio had not recovered. The combination of market losses and ongoing withdrawals had reduced his assets to about $500,000. He was 77 years old with less than half the money he had at 65. He had to dramatically reduce his lifestyle. He sold his house and moved to a smaller place. He cut expenses everywhere he could. The retirement he had envisioned was gone. That conversation with Richard changed how I think about retirement investing. It made me realize that the rules really are different when you are over 70. You cannot afford to take the same risks as someone with decades ahead of them. A 40% drawdown that a 30-year-old can ride out might be catastrophic for someone who needs to make withdrawals. Time is not on your side the way it is for younger investors. I have thought about Richard's situation countless times since that conversation. What could he have done differently? The answer is not that he should have avoided stocks entirely. Stocks provide the growth and income that retirees need to maintain their purchasing power over decades of retirement. The answer is that he should have owned different stocks selected specifically for their defensive characteristics and income reliability. And he should have had more of his portfolio in truly safe investments that would not collapse during a crisis. I also think about what his advisor got wrong. The advisor was following a conventional rule of thumb about age and asset allocation. But that rule was designed for accumulation, for building wealth over time. It does not account for the unique challenges of decumulation, of drawing down a portfolio while trying to make it last. When you are taking withdrawals, sequence of returns risk becomes critical. A crash early in retirement does far more damage than a crash later, because you are selling shares at depressed prices to fund your withdrawals. Richard's advisor did not account for this, and Richard paid the price. So what should someone over 70 actually do with their money? Let me give you a framework that will make everything else I share today make sense. The framework has 3 principles. First, income over growth. When you are over 70, your primary goal should be generating reliable income, not growing your portfolio. Growth is nice if it happens, but income is essential. You need money coming in every month to pay your bills. And that income needs to be predictable. The preservation over appreciation, protecting what you have is more important than making it bigger. A 20% gain followed by a 20% loss does not leave you even. It leaves you down 4%. And if you are making withdrawals during that cycle, the damage is even worse. At your stage of life, avoiding big losses matters more than capturing big gains. Third, simplicity over complexity. You should be able to understand every investment you own. You should be able to explain it in plain English. If an investment requires sophisticated analysis or constant monitoring, it is probably not appropriate for a retiree. You have better things to do with your time than worry about your portfolio. Income over growth, preservation over appreciation, simplicity over complexity. These 3 principles guided my selection of the 4 safest investments for retirees today. Now let me tell you what they are. The second investment on my list, and I am starting here because it forms the foundation of any safe retirement portfolio, is Treasury bonds, specifically Treasury inflation-protected securities, known as TIPS. These are bonds issued by the United States government that are designed specifically to protect your purchasing power from inflation. Here is how TIPS work. When you buy a regular bond, you receive fixed interest payments. If you buy a bond paying 4%, you get 4% per year regardless of what happens to inflation. But if inflation runs at 5%, your 4% return actually loses purchasing power. You are falling behind even though you are receiving income. TIPS solve this problem. The principal value of a TIPS bond adjusts with inflation. If inflation is 3%, your principal increases by 3%. If inflation is 5%, your principal increases by 5%. And your interest payments are calculated on that adjusted principal, so they increase as well. You are guaranteed to maintain your purchasing power regardless of what happens with inflation. For someone over 70, this is incredibly valuable. You have probably lived through the inflation of the 1970s. You remember what it felt like to watch prices rise faster than your income could keep up. TIPS ensure you never have to experience that again with a portion of your portfolio. Now, some people will tell you that TIPS yields are low, and that is true compared to riskier investments. But compare them to the alternative. Regular Treasury bonds pay a fixed rate, and if inflation spikes, you lose purchasing power. Corporate bonds pay higher rates, but they carry credit risk, the risk that the company cannot pay you back. TIPS pay a modest real yield above inflation with essentially zero credit risk, because the United States government backs them. I recommend that retirees over 70 allocate at least 20 to 25% of their portfolio to TIPS. You can buy them directly from the Treasury through their website, or you can buy them through low-cost ETFs that hold baskets of TIPS. Either way, you are getting inflation protection backed by the full faith and credit of the United States government. There are some practical considerations with TIPS that you should understand. First, TIPS generate what is called phantom income each year. The inflation adjustment to your principal is taxable, even though you do not receive any cash from that adjustment. This makes tips somewhat inefficient to hold in taxable accounts. If possible, hold your tips in tax-advantaged retirement accounts like IRAs, where you will not owe current taxes on the phantom income. Second, tips prices can be volatile in the short term, even though they are guaranteed to maintain purchasing power if held to maturity. When interest rates rise, tips prices fall, just like regular bonds. If you need to sell before maturity during a period of rising rates, you might sell at a loss. The solution is to hold tips as part of a long-term allocation, not as a short-term trading vehicle. If you need money soon, keep it in shorter-term instruments. Third, there are different types of tips with different maturities. Short-term tips maturing in 5 years or less are less volatile but typically offer lower yields. Long-term tips maturing in 20 or 30 years offer higher yields but more price volatility for most retirees. Intermediate-term tips maturing in 5 to 10 years offer a reasonable balance. Or you can buy a tips fund that holds a mix of maturities and let the fund manager handle the details. Let me tell you why this matters so much in the current environment. We have just lived through a period of significant inflation. Prices rose faster in 2021 and 2022 than at any time in 40 years. Many retirees watched their purchasing power decline dramatically. Those who held tips were protected. Their principal increased with inflation, and their income increased as well. They maintained their standard of living while others were forced to cut back. The first investment on my list is what I consider the single most important holding for any retiree over 70. Dividend aristocrats are companies that have increased their dividends every year for at least 25 consecutive years. These are not ordinary dividend stocks. They are elite businesses that have proven they can maintain and grow their payouts through recessions, through market crashes, through every kind of economic disruption. Think about what it means to increase your dividend for 25 consecutive years. You had to increase it during the dot-com crash. You had to increase it during the 2008 financial crisis. You had to increase it during the pandemic. Companies that can do this are not ordinary businesses. They have competitive advantages that allow them to generate consistent profits, regardless of economic conditions. For a retiree, dividend aristocrats provide exactly what you need: reliable income that arrives in your account every quarter, income that grows over time to help offset inflation, and relative stability during market downturns, because companies with long dividend histories tend to be more defensive than the overall market. Let me give you some specific examples. Johnson & Johnson has increased its dividend for over 60 consecutive years. Procter & Gamble has increased its dividend for over 65 consecutive years. Coca-Cola has increased its dividend for over 60 years. These companies have been paying shareholders through every crisis for more than half a century. That track record is not luck. It is the result of business models designed for durability. Now, I want to be clear about something. Dividend aristocrats will decline during market crashes. Everything declines during crashes, but they typically decline less than the overall market, and they continue paying dividends throughout. During the 2008 crisis, while the S&P 500 fell 57%, many dividend aristocrats fell only 30 to 40%. More importantly, they kept paying and raising their dividends. Investors who held these companies received income throughout the crisis, income they could use to buy more shares at depressed prices or simply to pay their bills without selling. I recommend that retirees over 70 allocate 30 to 40% of their portfolio to dividend aristocrats. You can buy individual companies if you want to select specific names, or you can buy ETFs that hold baskets of dividend aristocrats. Either approach works. The key is getting exposure to these elite dividend-growing companies. Here is something most people do not understand about dividend investing. The yield you see quoted is based on the current stock price. But if you hold these companies for years, your effective yield on your original investment grows dramatically. If you buy a company yielding 3% and the dividend grows at 7% per year, in 10 years your yield on cost is nearly 6%. In 20 years, it is nearly 12%. You are generating substantial income relative to what you originally invested, and that income keeps growing. Let me give you a real-world example of how this works. Imagine you invested $10,000 in a dividend aristocrat 20 years ago when it was yielding 3%. That initial investment generated $300 per year in dividends. But the company increased its dividend every year, averaging about 7% annual growth. Today, that same investment is generating over $1,100 per year in dividends. Even though you never added another dollar, your yield on cost is over 11%. Now imagine you are 70 years old and you need income to live on. Would you rather have investments that pay a fixed 3% forever, or investments that pay 3% today but 11% in 20 years? The answer is obvious. You want the growing income because at 70, you might easily live another 20 or 25 years. Your income needs will not stay static during that time. Inflation will push prices higher. Healthcare costs will likely increase. You need income that grows, and dividend aristocrats provide exactly that. There's another benefit to dividend aristocrats that most people overlook. Because these companies have committed to increasing their dividends for decades, management is highly motivated to protect the dividend. They will cut other expenses, delay capital projects, even take on some debt rather than break their dividend growth streak. This commitment provides a margin of safety for investors. Management teams do not want to be the ones who ended a 60-year streak of dividend increases. The third investment I recommend for retirees over 70 is one that many people overlook. High-quality municipal bonds provide tax-free income that can significantly improve your after-tax returns, especially if you are in a higher tax bracket. When you receive income from most investments, you pay federal income tax on that income. Depending on your state, you may also pay state income tax. These taxes can take a significant bite out of your returns. If you are in the 22% federal bracket and your state taxes investment income at 5%, more than a quarter of your investment income goes to taxes before you can spend it. Municipal bonds change this equation. The interest you receive from municipal bonds is exempt from federal income tax. And if you buy bonds issued by your own state, the interest is typically exempt from state income tax as well. This tax advantage can be substantial. Let me give you a concrete example. Suppose you can buy a corporate bond yielding 5% or a municipal bond yielding 3.5%. At first glance, the corporate bond looks better. 5% is more than 3.5%. But after taxes, assuming a 22% federal rate and 5% state rate, your corporate bond yields only 3.6%. The municipal bond still yields 3.5%, because you pay no taxes on that income. The after-tax returns are nearly identical, and the municipal bond carries less risk because municipal defaults are extremely rare. For retirees in higher tax brackets, municipal bonds can actually provide higher after-tax income than corporate bonds with similar credit quality. But this is especially valuable if you have significant assets and your retirement income puts you in a meaningful tax bracket. I recommend allocating 15 to 20% of a retirement portfolio to high-quality municipal bonds. Focus on bonds rated A or higher by the major rating agencies. Avoid reaching for yield by buying lower-rated municipal bonds. The additional income is not worth the additional risk, especially for a retiree who cannot afford losses. Zone important consideration with municipal bonds is that you should generally hold them in taxable accounts, not in retirement accounts like IRAs. The tax exemption is wasted inside an IRA, because IRA withdrawals are already taxed as ordinary income, regardless of what generated the returns. Keep your municipal bonds in taxable accounts and use your IRA space for investments that generate taxable income. The fourth investment I recommend might surprise you because it involves stocks. And many people think retirees should avoid stock entirely, but utility stocks occupy a special place in the investment universe. They provide reliable income, relative stability, and exposure to essential services that people need regardless of economic conditions. Utility companies provide electricity, natural gas, and water. These are not discretionary services. People do not stop using electricity during recessions. They do not cancel their water service when the stock market crashes. Demand for utilities is remarkably stable across economic cycles, which translates into remarkably stable revenues and profits for utility companies. Because utilities are regulated monopolies in most areas, they have predictable business models. They invest in infrastructure, they charge customers rates approved by regulators, and they earn allowed returns on their investments. This predictability makes utilities excellent dividend payers. Many utility companies have paid dividends for over a century, and the largest utilities have increased their dividends for decades. For a retiree, utility stocks provide several benefits. First, they yield more than most other safe investments. A typical utility yields between 3 and 5%, significantly more than treasury bonds. Second, those dividends tend to grow over time, typically at 3 to 5% per year, which helps offset inflation. Third, utility stocks are relatively stable, declining less than the overall market during crashes because their revenues remain steady. I recommend allocating 15 to 20% of a retirement portfolio to utility stocks. You can buy individual utility companies if you have specific names you like, or you can buy utility sector ETFs that provide diversified exposure. The key is getting that steady, growing income from essential services. Let me tell you about what happened to utility stocks during the 2008 crisis. While the S&P 500 fell 57%, the utility sector fell only about 40%. That is still painful, but it is meaningfully less painful. And utility dividends remained stable throughout. Investors who owned utilities collected their dividend checks every quarter, while the world seemed to be falling apart around them. I want to share something specific about how I think about utility stocks in a retirement portfolio. Many investors view them as bond substitutes, something you own for yield and stability, but they are actually better than bonds in one critical way. Their income grows. A bond pays fixed interest that never increases. A utility stock pays a dividend that typically grows 3 to 5% per year. Over a 20-year retirement, that growth makes an enormous difference. Consider this comparison. You invest $100,000 in bonds yielding 4%. 20 years later, you are still receiving $4,000 per year in income. But that $4,000 buys much less than it did 20 years ago because of inflation. Now consider investing that same $100,000 in utility stocks yielding 4% with 3% annual dividend growth. 20 years later, you are receiving over $7,000 per year in income. Your purchasing power has not just been maintained, it has increased. There's another aspect of utility stocks that makes them particularly valuable right now. The energy transition is creating massive investment opportunities for utilities. Billions of dollars are being invested in renewable energy, in grid modernization, and electric vehicle charging infrastructure. Regulated utilities earn allowed returns on these investments. More investment means more earnings, which means more dividend growth. The utilities you buy today could see accelerating dividend growth over the next decade as these investments come online. Now let me synthesize what I have shared and explain how these 4 investments work together to create a safe retirement portfolio. The dividend aristocrats provide your highest yielding, highest quality equity exposure. They give you ownership in elite businesses with decades of proven dividend growth. They will be the most volatile component of your portfolio, but they also offer the most potential for income growth over time. The Treasury inflation-protected securities provide your inflation hedge and your safest possible investment. They guarantee that a portion of your portfolio will maintain purchasing power regardless of what happens with inflation. In a high-inflation environment, they protect you. In a low-inflation environment, they still provide modest positive real returns. The municipal bonds provide tax-efficient income that improves your after-tax returns. For retirees in meaningful tax brackets, this tax efficiency can add significant value over time, and high-quality municipal bonds are among the safest fixed-income investments available. The utility stocks provide additional income with more stability than the broader stock market. They give you exposure to essential services that people need in any economy, and their dividends tend to grow, helping you keep pace with inflation together. These 4 investments create a portfolio that emphasizes income, prioritizes preservation, and remains simple enough for anyone to understand and manage. You are not chasing high returns, You are not speculating on what might happen. You are building a foundation designed to provide reliable income for the rest of your life. Let me give you a specific allocation that I think works well for most retirees. Over 35% in dividend aristocrats, 25% in tips, 20% in high-quality municipal bonds, 20% in utility stocks. This gives you 55% in equities, which might seem high. But remember that these are defensive, income-focused equities, and it gives you 45% in fixed income, split between inflation-protected treasuries and tax-efficient municipal bonds. With this allocation, a $1 million portfolio might generate $40,000 to $50,000 per year in income between dividends and interest. That income should grow at 2 to 4% per year as dividends increase, helping you keep pace with moderate inflation. And the portfolio should be relatively stable during market downturns, declining less than the overall market and recovering faster. Now let me address something important. This allocation is a starting point, not a prescription. Your specific situation matters. If you have pension income or substantial Social Security, you might be able to take more equity exposure because you have guaranteed income covering your basic needs. If you have significant health concerns that might require large near-term expenses, you might want more in safe liquid investments like tips and short-term bonds. Adjust based on your circumstances. There is another consideration that many retirees overlook. Where you hold these investments matters almost as much as what you hold. Municipal bonds should be in taxable accounts to capture the tax exemption. Tips can be in either taxable or retirement accounts, though retirement accounts are often preferable because tips generate phantom income that is taxable, even though you do not receive cash. Dividend stocks can be in either location, though qualified dividends receive favorable tax treatment in taxable accounts. Think about the tax implications of where you place each investment. I want to talk about what these investments will not do, because setting realistic expectations is important. They will not make you rich. If you are looking to double your money in 5 years, this is the wrong approach. But at 70 plus, you should not be trying to double your money. You should be trying to preserve what you have and generate reliable income. They will not completely protect you from market declines. When the market crashes, even defensive investments fall. You might lose 20% during a severe downturn, but that is far better than losing 50%, and the income keeps flowing throughout. Your job during crashes is simply to hold on and keep collecting your dividends and interest. They will not beat the market in bull runs. When stocks are soaring, your conservative portfolio will lag behind. Your neighbor who is fully invested in growth stocks will have better returns. But your neighbor is also taking risks that are inappropriate for someone who cannot afford significant losses. When the next crash comes, and it will come, your conservative portfolio will hold up far better. What these investments will do is provide peace of mind. You will know that your income is reliable, that your principal is reasonably protected, that you can afford to live your life without constantly worrying about the stock market. That peace of mind is worth more than any additional return you might earn by taking more risk. I think about my conversation with Richard often. He did everything conventional wisdom told him to do. He saved diligently. He worked with an advisor. He followed the standard recommendations. And he still ended up in a terrible situation because those recommendations were wrong for someone his age. If Richard had invested the way I am describing, with an emphasis on income, preservation, and simplicity, his outcome would have been dramatically different. His portfolio would have fallen less during the crisis. His income would have remained stable throughout. He would have had the ability to wait out the downturn without being forced to sell at the worst possible time. He might have reached his 80s with his wealth and lifestyle intact. You have the opportunity to learn from Richard's experience. You have the opportunity to position your portfolio for safety before the next crisis arrives, because another crisis will arrive. We do not know when, we do not know what will trigger it, but we know with certainty that markets will crash again, that prices will fall dramatically, that fear will spread and people will panic. When that day comes, and it will, I want you to be prepared. I want you to own investments that can weather the storm. I want you to have income that keeps flowing, regardless of what the market does. I want you to sleep well at night knowing that your financial future is secure. That is what these four investments provide. Not excitement, not the thrill of big gains, just steady, reliable, boring returns that let you enjoy your retirement without financial worry. And at this stage of life, boring is exactly what you should want. I have one final thought I want to share with you. The financial industry makes money by convincing you that investing is complicated, that you need sophisticated strategies, and constant adjustments and professional management to succeed. That narrative serves their interests, not yours. The truth is that simple, boring portfolios built around the principles I have described, income preservation and simplicity, outperform most sophisticated strategies over time. And they do so with far less stress, far less cost, and far less risk of catastrophic loss. You do not need to beat the market. You do not need to find the next great stock. You do not need to time your entries and exits perfectly. You just need to own safe investments that generate reliable income, hold them through whatever volatility comes, and let time work for you. That is not complicated, it is not exciting, but it works. And at this stage of your life, what works is all that matters. The investments I have described are not secrets. Dividend aristocrats, tips, municipal bonds, and utility stocks are all well known, widely available, and easy to buy. What separates successful retirees from unsuccessful ones is not access to special investments. It is the discipline to build a sensible portfolio and stick with it. The patience to collect income through ups and downs without panicking, and the wisdom to prioritize safety over speculation. You have that wisdom. You have lived long enough to know that get-rich-quick schemes rarely work, that steady progress beats dramatic swings. That peace of mind is worth more than a few extra percentage points of return. Trust that wisdom, build a portfolio that reflects it, and enjoy the retirement you have earned.